Hello and welcome to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the week ended June 19, 2013, the conventional mutual funds industry saw inflows to equity funds, outflows from bond funds, and no one really seemed to understand where the Fed was heading with its quantitative easing tapering program. As I mentioned, the tapering program has gotten things a bit confused for investors, but let's look at the macro groups and see what sense we could make of it. Equity funds had inflows of about $1.5 billion this week. Taxable bond funds, $619 million in outflows. Municipal debt funds had a big $2.2 billion in outflows, and money market funds also had outflows, about $22.2 billion for them. Well, that taper tantrum that the equity markets threw this week didn't seem to throw equity mutual fund investors off their game. As I mentioned earlier, they had about $1.5 billion in inflows. Now here we see the market was up about 85 basis points for the week. That included some good results at the end of last week, which gets captured in our flows week, not the same as a calendar week. Therefore, a lot of the activity that we saw later in this week didn't get captured here in terms of performance or in the activities of investors who may change their mind come next week. This comes after 4 weeks of negative performance. So again, investors might be ready to start changing their tune when it comes to whistling about equity funds. Domestic equity funds had inflows about $730 million, while non-domestic had inflows about $750 million. Investors relatively split on those two. And we saw it in the top collecting groups this week. International multi-cap value funds had taken in a couple $100 million. Multi-cap value funds on the domestic side also took in a couple $100 million. Again, the worst of this week was one that's been the bottom of the board on several weeks this year, large cap growth funds. They had outflows of about $340 million. Well, between equity ETF investors and equity mutual fund investors, there wasn't much difference of opinion this week. If we turn our attention to equity ETFs, we saw about $3.2 billion in net inflows this week. This follows 3 weeks of outflows, so you're more attuned, more interested investor back into equities this week. The leaderboard was SPY, the SPY. It had about $2.4 billion in inflows. The Consumer Staples ETF XLP had about $535 million in inflows, while the Emerging Market EEM ETF had outflows about $1.3 billion. Elsewhere, a lot of the losers this week were gold and emerging markets. Both of those were losing significantly in terms of performance, so no wonder that they also lost in terms of flows. Well, the next group we'll take a look at is taxable bond funds. Again, they had about $619 million in net flows this week. Lighter outflows than the last couple of weeks. Remember, they had 3 weeks of outflows, but this week they had positive performance. So we did see a tapering of the outflows. Perhaps we might even start to turn into some inflows later on. Again, we'll have to get more clarity and maybe let the market digest the comments by the Fed Chairman regarding the tapering program for the bond buying that's been going on for quite some time. Loan funds remained in the driver's seat. They took in about $1.3 billion this week. Interestingly enough, the core bond holding for a lot of investors, intermediate investment grade, that classification had outflows about $591 million. Elsewhere, the outflows were also pretty good, but the permanent portfolio has had a rough go of it, at least this year and back into last year as well. This week they had about $179 million in outflows. That was the worst, while a Goldman Sachs Strategic Income Fund had one of its best weeks ever. It took in about $216 million. Well, for those ETF investors who like to buy bond portfolios, this was an okay week for them. They allocated about $100 million in net inflows, kind of a quiet week for them. This comes after 5 consecutive weeks of outflows, so we're probably starting to see a little more interest in certain bond strategies being selectively chosen by these investors. This week we saw short duration and certain treasury products with inflows, while inflation and certain corporate debt strategies tended to be on the outflows side. So kind of a tale of two cities on that side. We saw even though there's a little more risk taking out there, it tended to be toward the shorter duration products, at least on the fixed income side. So kind of a strange position right now in the market. The next group we'll take a look at is municipal debt funds. Again, they had $2.2 billion in outflows this week. This is the fourth consecutive week of outflows. This also marks the seventh consecutive week of downside performance. So not a wonder that we saw outflows this week. All major classifications in the muni debt world had outflows. The high yield muni debt fund group led the charge, $850 million this week. I personally expect to see bigger outflows over the next several weeks. Yields seem to be perking up quite a bit lately in the muni debt space, and we'll probably get more than $2 billion a week outflows in the near future. The last group to take a look at is money market funds. They had outflows of $22.2 billion, led entirely by institutional investors who took back about $26.1 billion, while retail money market fund investors allocated a net $3.8 billion this week. So looking only at retail investors on the mutual fund side, we can kind of see where a lot of the money was just shifting around this week. On the institutional side, it's really harder to decipher. If we're looking at ETFs specifically, the inflows certainly have nowhere near as much magnitude as the outflows from institutional money markets. So the two are probably not related. Well, feel free to join us again next week where we'll discuss the ins and outs of the mutual fund and ETF industries, or join us online at any time at www.lipperusfundflows.com. Thanks for joining.